Here's a number that should stop you for a second. As of this month, TrendForce data shows DDR4 memory, the kind of chip that's been sitting in computers for over a decade, is projected to jump more than 50% in price in just the third quarter of this year alone. Not since 2010, not over 5 years. 1 quarter. And DDR4 isn't even the memory anyone actually wants anymore. It's old technology, and it's still getting more expensive by the month because of something that has nothing to do with DDR4 at all. That's the small story. Today, I want to walk you through the big one, because underneath that memory chart sits something genuinely unprecedented. 5 of the most profitable companies in the history of capitalism, Microsoft, Amazon, Alphabet, Meta, and Oracle, are now spending more building AI infrastructure than their entire businesses generate in cash. And the financing gap that creates is being filled with something these companies have almost never needed before: debt. Serious, escalating quarter-over-quarter debt. Before I get into the numbers, quick favor. If this kind of grounded, source-based breakdown is useful to you, hit like and subscribe if you're new, because I'm going to walk through this the same way I always do. Real figures, a fair bear case, a fair bull case, and no false certainty either direction. Anyone telling you they know exactly how this ends is selling you something. Let's start with the scale, because the raw dollar figures genuinely don't feel real until you see them lined up. According to CreditSights research, the top 5 hyperscalers spent roughly $256 billion combined on capital expenditure in 2024. That climbed to around $443 billion in 2025. For 2026, the current projection sits at approximately $602 billion, a 36% jump in a single year, with an estimated 75% of that spend going directly toward AI infrastructure. Goldman Sachs, looking further out, projects combined hyperscaler capex from 2025 through 2027 will reach $115 trillion, more than double the $477 billion these same companies spent across the entire 2022 to 2024 period. To put one company's slice of that in perspective, Amazon's 2026 capital expenditure alone reportedly exceeds the combined capex of the entire publicly traded U.S. energy sector. That's one company's AI build-out, outspending an entire industry that powers the country. And here's the part that actually matters for how this gets paid for. Capital intensity, meaning capex as a share of revenue, has hit levels these companies have simply never operated at before. CreditSights puts Oracle's most recent quarterly figure at 57% of revenue going straight into capex, and Microsoft at 45%. For context, that kind of ratio has historically belonged to industrial utilities and telecom companies, not software businesses that used to be celebrated precisely because they didn't need heavy physical infrastructure to grow. That's the entire investment thesis these 5 stocks were built on for 2 decades, quietly inverting in real time. So how is the gap between operating cash and capex actually getting filled? Debt, and increasingly, off-balance sheet debt that doesn't even show up in the headline numbers everyone's watching. According to Moody's, reported in early 2026, hyperscalers are now sitting on approximately $662 billion in data center lease commitments that have been signed but haven't formally commenced yet, meaning under current accounting rules, they don't appear in the capex figures. Analysts are tracking. That $662 billion figure is larger than these companies' combined on-balance sheet debt. On the visible side, hyperscalers raised over $100 billion in bonds in 2025 alone, and JP Morgan and Morgan Stanley are now projecting the sector may need something on the order of $1.5 trillion in new debt issuance over the next several years just to keep this build-out funded. Independent analysis from Anomaly Investments, examining Amazon specifically, found the company's trailing 12-month capital expenditure has already climbed past $151 billion, exceeding its own operating cash flow entirely and pushing free cash flow into negative territory. Now, I want to be precise here, because it's genuinely easy to overstate this into something it isn't. These companies are not going bankrupt. That needs to be said plainly. All 5 remain enormously profitable, and JP Morgan's own mid-year 2026 outlook projects their combined operating cash flow will actually surpass $900 billion by 2027, arguing the debt markets are holding fine and the cycle still has real room to run. This is not a company on the verge of collapse. This is something more specific and, frankly, more interesting. The financing structure underneath the entire AI economy shifting from cash, which doesn't care what anyone thinks of your 5-year roadmap, to debt, which absolutely does. Debt has a schedule. Debt has creditors who expect to be paid on time regardless of whether the technology they funded has proven itself yet. And that shift in financing is exactly what's now bleeding directly into consumer electronics pricing, into the DDR4 chip sitting in whatever device you're watching this on right now, and into a lawsuit that's currently making its way through federal court in California. That's exactly where I want to take you next, because understanding the memory market is, in my opinion, the single clearest window anyone outside of finance actually has into whether this entire build-out is real or running on fumes. Drop a comment telling me if you've personally noticed electronics getting more expensive this year, because I want to see how widely this is actually being felt before we go further. Continue when you're ready, and I'll break down exactly why your next laptop or phone is going to cost more, and for how long. Let's actually break down why memory has become the single most honest indicator of what's happening in this entire AI economy. Because once you understand the mechanics here, you'll understand why your next device purchase is going to hurt more than it used to, and for longer than most people realize. 3 companies, Samsung, SK Hynix, and Micron, control somewhere between 90 and 95% of the world's DRAM production. DRAM is the memory that sits inside literally everything. Your laptop, your phone, your car, your TV, your game console. Normal DRAM is not what powers AI data centers, though. AI accelerators need something called HBM, high bandwidth memory, stacked in layers, typically 12 to 16 high, and according to IDC's own research, producing HBM consumes roughly 3 to 4 times the wafer capacity per gigabyte compared to standard DRAM. That ratio is the entire story in one sentence. Every wafer of fab dedicates to an HBM stack destined for an nvidia GPU is a wafer that does not go toward the memory module in your next laptop. And the economics behind that decision aren't complicated, they're just brutal. A single HBM module can sell for tens of dollars more per unit than a comparable amount of standard consumer memory, and manufacturers are, unsurprisingly, rational actors, chasing the highest margin available to them. IDC's analysis frames this precisely as a zero-sum allocation problem. This isn't a temporary cyclical shortage caused by a factory fire or a pandemic supply chain snarl the way 2020 to 2022 was. This is described by multiple research firms as a structural, likely permanent reallocation of global silicon wafer capacity, driven entirely by hyperscalers willing to place open-ended orders with memory suppliers, agreeing to accept as much supply as they can get regardless of price. The resulting numbers are genuinely historic. TrendForce data shows DRAM contract prices jumped somewhere, between 80 and 90% quarter over quarter heading from Q4 2025 into Q1 2026. Some DDR5 SKUs specifically rose 3.5 to 4 times over that same window. VersaLogic's supply chain tracking noted individual memory components have increased as much as 700% compared to historical pricing, with lead times stretching to 32 to 40 weeks or more. And it's not slowing down the way anyone hoped. Tom's Hardware, citing the most recent TrendForce survey published this month, shows conventional DRAM contract prices are still projected to rise another 13 to 18% in the third quarter of 2026 alone. DDR4 specifically, again, the old, supposedly safe fallback option, is projected by DigiTimes to jump over 50% in that same quarter as legacy production keeps getting deprioritized in favor of higher margin server-grade output. The consumer-facing damage from this is already extensive and well documented. HP has disclosed that memory now accounts for roughly 35% of the total bill of materials for building a PC, up from somewhere around 15 to 18% before this shortage began. Major PC makers, including Dell, HP, and Lenovo, have raised prices somewhere in the 15 to 20% range in response. Apple, which had reportedly secured longer-term DRAM supply agreements than most of its competitors, still announced immediate price increases across iPads, Macs, HomePods, Vision Pro, and Apple TV back in late June, a move that reportedly sent Apple shares down more than 6% in a single day, their worst trading day since the market crash back in April 2025. IDC's current projections put global smartphone shipments down roughly 12.9% for the year, and the PC market contracting by about 11.3%, driven largely by this exact dynamic. And the effect isn't landing evenly. Counterpoint Research has documented 10 to 20% price increases specifically hitting budget Android devices, the segment with the thinnest margins and the least room to absorb. Rising component costs, while premium devices above roughly $800 have proven far more resilient because buyers in that bracket are simply less price sensitive. This is also where the legal story comes in, and it's worth understanding clearly because it's still an open, unresolved question rather than a settled fact. On June 25th of this year, a group of plaintiffs filed a federal class action antitrust lawsuit against Samsung, SK Hynix, and Micron in the Northern District of California. The allegation, filed under the Sherman Act, claims the 3 companies used the industry-wide shift toward HBM production as cover to simultaneously coordinate a squeeze on conventional DDR3, DDR4, and DDR5 output. And the complaint alleges that this resulted in price increases of roughly 700% over 4 years. Media coverage has taken to calling this the RAM apocalypse. It's important to be precise about what this actually is right now, an allegation, not a finding. The companies involved maintain they are simply responding independently to genuine market demand, which is a legitimate defense, since in a market with only 3 major suppliers, everyone rationally chasing the same higher margin product can look identical to coordination without actually being coordination. Courts have a term for this, conscious parallelism. And a previous antitrust case brought against these same companies on similar grounds was dismissed on exactly that basis. That said, this isn't a baseless accusation invented out of nowhere either. Samsung and SK Hynix have both pleaded guilty to criminal DRAM price fixing in the past. SK Hynix, specifically, paid a $185 million fine back in 2005 for exactly this kind of conduct. So there's real historical precedent behind the suspicion, even if this particular case hasn't been proven. And regardless of how the lawsuit resolves, whether this turns out to be coordinated behavior or simply 3 companies independently making the same rational margin maximizing decision at the same time, the effect on anyone buying a phone or laptop right now is identical either way. You're paying more, and that additional margin is flowing directly into the companies now sitting at the center of the biggest infrastructure build-out in modern history. So we've now covered the scale of the spending and exactly why your electronics are getting more expensive. The real question left is whether any of this actually pays off, and that's where things get genuinely uncertain, even among the people whose entire job is figuring this out. I want to walk you through the honest bear case next, the real reasons serious analysts are worried this doesn't end well, before giving equal time to the case for why it might. If you're finding the actual mechanics behind this useful, rather than just vibes and headlines, that's exactly why subscribing matters here. So go ahead and do that now. Continue when you're ready, and we'll get into the risk side of this. Let's get into the bear case, honestly, because this is where the Tech Great Depression question in this video's title actually needs to be tested against real numbers rather than just vibes. And I want to give you the strongest version of this argument, not a straw man. Start with the revenue gap, because this is the number that should make anyone pause. Estimates of direct attributable AI services revenue across the industry currently sit somewhere in the range of tens of billions of dollars against infrastructure spending that's now running in the hundreds of billions annually and trending toward the $1 trillion mark. That's not a rounding error. That's a genuinely enormous gap between what's being spent and what's being clearly earned back from it. And here's a detail worth sitting with. None of these 5 companies currently break out clean audited AI revenue as its own standalone reported segment. You get growth rates, you get phrases like momentum and run rate. You rarely get an actual dollar figure that says, plainly, this is what AI specifically earned us this quarter. When a company has genuinely strong numbers to show, the normal instinct is to show them clearly. The absence of that clean disclosure is, at minimum, worth noticing. Then there's the asset life problem. A data center itself is typically built to last around 30 years. The GPUs and accelerators sitting inside it, the actual compute doing the AI work, are realistically useful for maybe 3 to 5 years before newer hardware outclasses them. That mismatch means these companies are borrowing against long repayment schedules to buy equipment with a comparatively short, useful life. Independent analysis from Anomaly Investments, published in June of this year, flagged exactly this dynamic, noting that if the depreciation schedules these companies are currently using turn out to have been overly optimistic, meaning if the hardware actually needs replacing sooner than the books assume, the resulting write-downs could be enormous. And that same analysis is precisely why the shift from equity financing to debt financing matters so much. Debt doesn't get more forgiving if an asset turns out to be worth less than expected on the balance sheet. It still has to be repaid on schedule. Layer the memory data we just walked through directly on top of that, because it makes the math actively worse in real time. The cost of building? The exact same amount of AI compute capacity is rising faster than the build-out itself is scaling. With DRAM and HBM prices still climbing double digits per quarter according to TrendForce's most recent Q3 in 2026 projections, every quarter a company waits to lock in hardware. The bill for executing the identical expansion plan goes up. For a single gigawatt scale data center, the high bandwidth memory component alone runs into the billions of dollars. That's not a marginal cost creeping upward. That's the core input to this entire build-out, becoming structurally more expensive month over month, with IDC and Kearney's per lab research, both suggesting this specific supply constraint persists at least into 2027, and by some estimates, as late as 2030. And then there's concentration risk, which is genuinely the sharpest structural difference between this moment and prior speculative bubbles. The dot-com bubble at the turn of the millennium was distributed across thousands of individual companies, most with no meaningful revenue at all, so no single failure could meaningfully move the entire market. This is completely different. This is effectively 5 buyers, Microsoft, Amazon, Alphabet, Meta, and Oracle, sitting at the absolute center of an interconnected financing web that touches memory manufacturers, chip designers, power utilities, and construction firms simultaneously. If even one of those 5 companies' CFOs stands up on an earnings call and says something as simple as, "We're moderating CapEx growth," that single sentence doesn't stay contained to that one company's stock price. It ripples immediately through memory suppliers, chip makers, data center construction firms, and power providers all at once, because so much of the current valuation across that entire supply chain assumes continued uninterrupted hyperscaler spending. In a tightly centralized system like this one, you genuinely don't need a full-blown collapse to trigger serious market pain. You just need one flinch from one of 5 companies. It's also worth being honest about how this compares to prior infrastructure cycles, because the comparisons people reach for aren't quite right, and understanding why matters. The late 1990s telecom bubble involved laying fiber optic cable speculatively into markets with essentially unlimited eventual capacity, and critically, virtually no refresh requirement once it was in the ground. That fiber sat there, mostly unused, for years afterward. Data centers are structurally different. They're physically constrained by power availability and real estate. They're typically contractually committed to specific customers before construction even finishes. And they're subject to accelerated depreciation cycles rather than sitting dormant indefinitely. That distinction matters, and it's one of the stronger arguments against a direct telecom-style comparison. But the CFA-level analysis making that argument doesn't erase the debt financing risk sitting underneath the current build-out. It just means the failure mode, if there is one, likely looks different from empty fiber conduits gathering dust for a decade. So does all of this actually add up to something as severe as a tech Great Depression, the framing this video opened with? Based on everything we've walked through so far, honestly, not necessarily. And I want to be straight with you about that, rather than oversell the doom angle for a dramatic thumbnail. What the data supports clearly is a genuine structural shift in financial risk, a move from cash-funded growth, which is remarkably forgiving of delays and disappointments, to debt-funded growth, which is not forgiving at all. Whether that shift produces something as severe as a full-blown depression-level event depends entirely on questions nobody, including every analyst we've cited today, can currently answer with confidence. How fast AI revenue actually scales, whether depreciation assumptions hold up under real-world hardware refresh cycles, and whether that concentrated group of 5 buyers stays disciplined or starts blinking under pressure. That's the bear case, laid out as honestly and specifically as I can make it. But it's genuinely not the whole picture, and pretending it is would be just as dishonest as pretending the debt buildup doesn't matter at all. In the final section, I want to give the bull case equal serious weight because there are real analysts with real data making a genuinely strong argument that this cycle is fundamentally different from a bubble about to pop. And then I want to hand you the specific concrete indicators that will tell you which way this actually breaks before it ever shows up in a headline. If this breakdown is giving you a clearer, more grounded picture of the risk here, subscribing is exactly how this kind of analysis reaches more people instead of getting drowned out by panic headlines on one side and pure hype on the other. Let's give the bull case the same serious treatment we just gave the bear case, because dismissing it outright would be exactly the kind of dishonest, one-sided analysis this video is trying to avoid. Start with the most basic point, and it's an important one. These companies are still enormously profitable, all 5 of them. The crossover point, where combined free cash flow approaches 0, means they're spending essentially everything the business generates. Not that the underlying businesses are losing money. That distinction matters enormously because it means capital expenditure functions as a dial these companies can turn, not a cliff they're forced off of. If returns genuinely disappoint, they retain the real option to sequence, delay, or stretch out this build-out. And JP Morgan's own mid-year 2026 research explicitly backs this reading, projecting combined hyperscaler operating cash flow will actually surpass $900 billion by 2027, and describing the debt markets underpinning this cycle as, in their words, holding steady with real room left to run. The demand side of this argument is genuinely the strongest piece of the bull case, and it's worth taking seriously rather than waving away. These data centers are not sitting empty waiting for customers to show up. According to reporting this year, Google Cloud's order backlog nearly doubled in a single quarter, climbing past $460 billion. Reports have described these companies as compute-constrained rather than demand-constrained, meaning the bottleneck right now is physically building capacity fast enough, not finding buyers willing to pay for it. Analysts at firms like Allianz Research have pointed to global data center capacity roughly doubling by 2030, expanding from around 130 gigawatts today toward 260 gigawatts, with hyperscalers driving the overwhelming majority of that growth. That's not the profile of speculative capacity built ahead of any real customer. Sitting dark and unused the way fiber did in the early 2000s. There's also a structural argument specific to this cycle that doesn't map cleanly onto prior bubbles. Man Group's research on this describes AI's improvement curve as self-reinforcing, in a way telecom infrastructure never was, each meaningful. A capability jump tends to unlock new practical use cases, which in turn generates new demand for the exact compute being built right now. That feedback loop doesn't have a clean historical precedent, which genuinely cuts in both directions, since untested dynamics carry real uncertainty. But it does mean the simple claim that there's no real demand underneath this build-out is currently a weak one, given the backlog and capacity constraint data actually being reported. So where does that honestly leave us on the question this video opened with? My genuine read, and I want to be careful not to oversell, certainty in either direction here. The risk sitting underneath this cycle isn't that AI turns out to be useless technology. Even analysts who lean skeptical on near-term monetization, including researchers at Deutsche Bank, still concede that large language models carry real, substantial productivity potential over time. The actual risk is timing. That payoff, even under optimistic assumptions, arrives only once the technology is fully embedded across industries and genuinely effective use cases have been identified and scaled, and that process realistically takes years. Debt doesn't operate on that same timeline. Debt has a repayment schedule. The memory bill specifically arrives every single quarter, whether or not the broader AI revenue story has caught up yet. The technology itself being genuinely valuable and the current financing structure supporting it being sound are two separate questions, and both can be true or false independently of each other. So rather than trying to predict an outcome I genuinely can't know with confidence, here's a practical dashboard. 5 specific things worth watching that will tell you which direction this actually breaks before it shows up in a headline. First, watch corporate bond sales specifically. These are normally heavily oversubscribed, meaning far more investor demand. If hyperscaler debt issuance starts coming in thin, that's the credit market itself signaling reduced confidence, and it would likely be the earliest visible warning sign available. Second, watch for a company to finally break out a clean, audited AI revenue line as its own reported segment. The day any one of these 5 does that confidently is a real signal. Until then, if the language stays limited to run rate and momentum, that's worth treating with appropriate skepticism. Third, watch for the first public flinch, meaning any single CFO explicitly saying they're moderating CapEx growth. In a concentrated 5-buyer market, the first company to say that publicly effectively gives the other 4 cover to follow. Fourth, watch depreciation schedules closely. If a company quietly extends the assumed useful life of its servers, say from 5 years to 6, that's an accounting choice with a direct financial motive behind it. And it's worth treating as a tell rather than a footnote. Fifth, and the one I genuinely put at the very top because it's the hardest to fake, keep watching memory. As long as HBM stays effectively sold out and DRAM prices keep climbing the way TrendForce's most recent Q3 2026 data still shows, that's real, physical, unfakeable evidence that underlying demand for AI compute remains genuine. The day memory prices actually start softening in a sustained way is the day this build-out is genuinely slowing down. And based on everything we've walked through today, that day is not obviously close. So here's my honest, grounded takeaway heading into the back half of 2026. Memory stays expensive at least through 2027 and quite possibly into 2028, based on the fab construction timelines we've covered. That's closer to straightforward arithmetic than speculation. If you're planning a PC, phone, or console upgrade, the cheap era for those purchases is genuinely behind us for a while. The debt keeps flowing until at some point it doesn't, and the more realistic risk isn't a sudden refusal from credit markets. It's a slow, gradual widening of borrowing costs that makes this build-out progressively more expensive to finance rather than impossible. And expect continued pressure on anything inside these companies that isn't directly AI adjacent, since that capital has to come from somewhere. Is this the greatest capital allocation decision in corporate history? Or is it the setup for the most expensive lesson this industry has ever learned? Based on everything covered in this breakdown, the honest answer is that, from the outside, right now those two outcomes genuinely still look almost identical. Tell me where you land in the comments, greatest bet in history or most expensive lesson, and if this actually helped the financial side of the AI story click for you, go ahead and hit subscribe so the next update on this reaches you the moment the picture shifts. Thanks for sticking with the whole breakdown, and I'll see you in the next one.